we'll probably go somewhat higher in 2025. My target for 2026 is, I think we'll be well within the range of 3,000 to 7,000. I'm going to say high 5,000s probably. And that would merely be playing catch up with the level of government debt. The amount of the government debt has been increasing since 1971. So just playing catch up would take us into the high 5,000s.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for December 3rd through December 10th, 2024, while supplies last. Right now we have 1 ounce silver backdated South African Krugerrand at just $3.19 over spot per ounce. We also feature the limited edition 2024 1 ounce gold UK Lion and Eagle coin at just $99 over spot per ounce. And finally, 1/10 ounce gold Britannia are just $29.99 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Clive Thompson, retired Managing Director of Wealth Management. Clive, thank you so much for joining us today.
Elijah, thank you very much for having me on your show.
Well, it's great to have you back on. I did want to get an update on cryptocurrencies. We've talked a lot about the central bank digital currency reset that a lot of people are thinking is coming. And kind of on a similar topic is the topic of cryptocurrencies in general. Now, after Trump won, we saw just Bitcoin go to the moon. It's almost $100,000 per Bitcoin right now. Your perspective on what we've seen, and how does Trump winning impact cryptocurrencies, if at all?
First of all, I think it's quite important to distinguish between the general word crypto and Bitcoin. It's a bit like distinguishing between gold and metals. And metals encompass everything, and gold is a specific thing. And I'd like to talk really more about Bitcoin than the crypto space, because the reality is an awful lot of the cryptos out there are going to end up at zero. But that won't happen with Bitcoin, in my opinion. Trump is putting in place pro-crypto supporters in key positions. So we've gone from a government which was pretty anti-crypto to a government which is seemingly pro-crypto, and I think they've listened to their voters in America. A lot of Americans do own crypto. They've listened to their voters and said, we don't want to stifle America's innovation in this area by making it overly onerous for anyone to do business here. So I think when Mr. Trump becomes the president on the 20th of January, I think we're going to see a variety of moves which make America more crypto-friendly. Gary Gensler, who will resign on the 20th of January, has had a passion and a mission in life, as far as I can see, to try and shut down anything and everything crypto-related. And he'll be gone. Hopefully we'll have somebody who's a little bit more understanding that this is part of the new world in some way, shape or form, and they'll allow it to develop in America. And of course, if it does get that sort of permission, it's going to be very good for crypto in the long run. The reason crypto in general, but I think more importantly Bitcoin, the reason Bitcoin continues to make all-time highs, and it's been there countless times before, it goes down 70%, then up 100%, then down 70 and up 100. We've had this sort of cycle over and over again. And the reason it's doing that is people have realized that this is a scarce asset, but more importantly, a scarce asset that other people want. So just as other people want the dollar, if I say to you, would you like some dollars, and you give me something in exchange, surely you're going to take my dollars. But if I say to you, want some crypto, some specifically Bitcoin, a lot of people would take it off me, but there's a lot of people who won't. But we have a growing network of people. So provided the network of people who are willing to take Bitcoin and understand it grows faster than the new supply of Bitcoin, I do see the price continuing to move higher. And some of the very extreme price ranges that you've heard talked about I think everything is possible. We don't know how far it could go, but I think we're still very much at the beginning of the game, rather than the end of the game.
Now, this brings, I guess, us to the broader topic of, you mentioned, obviously, the distinction between Bitcoin and cryptocurrency. Now, central bank digital currencies seem to be kind of the maybe a false alternative, where a lot of the advantages of cryptocurrencies and Bitcoin are not seen in central bank digital currency, and it's actually the inverse of that, where you have, the government can completely track it, so it's not anonymous at all, and it wouldn't be limited in supply. Do you see this positive environment for Bitcoin having any impact on the movement towards central bank digital currencies around the world?
I don't think that central bank digital currencies and Bitcoin have any connection or will have any connection. I mean, they're as different as they possibly can be. Bitcoin is a totally decentralized system where it's impossible for anyone to change the rules or increase the supply. That's absolutely impossible. We get to 21 million Bitcoin very soon, and we'll never go beyond that 21 million Bitcoin. With the central bank digital currencies, the rules can be changed anytime they like, and the supply can be increased, decreased. They can decide to cancel every central bank digital currency ending the letter E if they want to. They can restrict what you can buy with it. If you perhaps, they think that you have done something naughty, perhaps you're a terrorist or a wanted criminal, they can cut you off. Well, we'd all applaud that. But what if it goes to the point where they say, some of you people are on benefits and we don't think you should be spending that money on alcohol or gambling, so we're going to restrict what you can spend the money on? Well, no, perhaps some of us would agree with it, some would not. But what about the next one, when they say we think you voted for the wrong person, or you went to a demonstration, you were protesting your rights last week because you wanted freedom of speech? Well, we don't think that was a good thing to be part of a protest, so we're going to cut you off as well. So you don't know how far it goes. I think that this work, when we get a digital currency, if we get one, of course, it's not certain we'll get one, but if we get one, they'll have lots of restrictions in place to say these sort of awful things can't and shouldn't and won't happen. But then little by little, there'll be an encroachment and a change in the rules where it becomes more and more controlling and more dystopian. So I don't see any connection between Bitcoin being getting more approval and central bank digital currencies getting approval, because I think one seems to me to be good, what people want, and the other one is what people actually would. They might find it very convenient to use, but down the line, they're going to find it very controlling. And I don't think people like to be told what to do.
Do you see any impact, though, with Trump winning? Do you see the movement towards, a Fed coin or U.S. government digital currency? Do you see that being halted in any way, or is that still your view that that's where we're heading?
I think Mr. Trump has come out and expressed views against allowing the central bank digital currency. It may still be an unstoppable path, and this may not come in during his administration. So I rather fear it's on its way. It's just a question of how quickly it gets there, and anything I can do to discourage it and slow it down, I'd be very happy to help. But I think Mr. Trump perhaps is a little bit more anti the central bank digital currency than Mr. Biden was.
One thing that you've also said that we're kind of past the point of no return in is the U.S. national debt, and how it keeps increasing compared to U.S. GDP. And this is, an unsustainable trajectory, and really there's no way to turn it around. So can you expand on that, kind of what we're seeing right now in the U.S. national debt and why it is so unstoppable?
We went through the 2008 financial crisis, and the government discovered that it could print money with impunity. Basically, it printed the money to give it to the banks to save the banking system. The too big to fail. I mean, if the banks had all failed, there'd be a complete chaos. So in a way, one could say that was the right thing. But what they discovered, that all this printing didn't create a surge of inflation. And having got into the habit of printing, they carried on to some extent. And then along came the COVID crisis. And then once again, everybody who was now locked up at home got their furlough payments and were being paid. And now we've gone back into a new world where they've had that budget, they've been spending it, and politicians still want to spend the money. So taking away people's benefits is a very hard thing for any government or any politician to do. The politician who says, I'm taking away your benefits, won't get voted for. So I think there's going to be a huge reluctance to take away any of the Social Security, Medicare type of benefits, which, and on the other hand, will they raise taxes? Well, they could, but they're not going to be able to raise them that much. It won't make that much of a dent in the deficit. So the deficit is the difference between what they're spending and what they're collecting in taxes. And they're collecting far less in taxes than they're actually spending on everything else. The trouble with the spending is 2/3 of it, they have no discretion at all about it. It's called non-discretionary spending. It's the benefit system. Another 1/6 is the army, and they're not going to stop spending that. And the remaining 1/6 is perhaps what they call discretionary, but I don't think they're going to make much progress on that 1/6. And even if they did, it wouldn't get rid of the huge deficit which is being generated each year. It'll reduce it slightly. So the deficit, which is at record levels, is set to continue to grow. Meanwhile, we've got the very large government debt, which is accumulated at a much faster rate than the gross domestic product. It's accumulated faster than the economy, which a lot of it was, that debt was taken on 5 years ago, 10 years ago, 6 years ago, at a time when interest rates were effectively zero. Now, as they're borrowing long term, they weren't borrowing at zero, but they were borrowing at 1 or 2%. So that debt, which had a lifespan of anything from 2 to 30 years, but a lot of it maturing over the next 5 or 6 years, that debt, as it matures, they stop paying interest on it at 2%, but they have to refresh it. They have to borrow more new money, but at the new rates. And the new rates are double the old rates. We're talking about 4% plus, 4.5% actually. So what we have is a much bigger pile of debt than we had over the last decade, which is having to be renewed at much higher interest rates. And on top of that, we have an ever-increasing deficit, increasing compared to GDP as well, which they have to borrow for that as well. And again, that has been borrowed at the higher interest rates. And last but not least, we've got at least we've had in the last year or so, the Federal Reserve, which is it has its tapering program, which basically means it's trying to reduce the size of its balance sheet by selling government bonds. They sold about $1 trillion of government bonds in the last year or so. So all of these are creating a much larger supply of treasuries coming to the market, and it's the government's having to borrow at a faster and faster rate, not only to finance the deficit, not only just to deal with the effect that the government, the Treasury, the Federal Reserve is not buying these bonds anymore, they're actually selling them, but also to finance the interest on the national debt at a faster rate. So that debt is getting, it's not, I won't say it's out of control, but it's going to get out of control. And that is the forecast of the Congressional Budget Office, the government itself, who forecast that the level of deficit, of debt to GDP, which currently stands at around 100% if you take into account the debt issued to the public, they're forecasting that's going to go above 200% and maybe 300%. Now, what does that mean? It means that when children are being born today, by the time they get into their 30s, they'll be living in a world where the debt pile, if it follows the trajectory as forecast by the Congressional Budget Office, or in the UK, the Office of Budget Responsibility, the debt pile is going to be 2 or 3 times what it is today in real terms. There'll be many more times that in monetary terms. And that's going to create a terrible burden either on the individuals in terms of much increased taxation, or more likely, and I think this is the likely outcome, we're going to stop interest rates spiraling out of control. The central banks will have been invited, and that means told, but invited to buy the bonds or the money that the government wants to borrow. And where does the central bank get the money to buy government bonds? It's from the printing press. So what does that mean? I think it means we move into a much more inflationary world down the line. And I'm guessing that's going to start probably late next year, when the government will start seeing that they have difficulty borrowing at reasonable rates. So I don't know what a reasonable rate would be, but I got a feeling that somewhere between 5 and 5.5 starts to become tough for the government to manage. And they're going to say to the central bank, would you like to buy some of our bonds, please? And the central bank, whether it does it willingly or not, will do so. And that will be printing money to buy the government bonds, which is inflationary. But I mean, from another perspective, we mustn't forget the fact that the government is borrowing money anyway in itself is also inflationary. Why is that? Because what's happening as the government borrows money, the government gets poorer and everybody else gets richer because the government's spending that money. So the government's deeper and deeper into debt and everybody else has got that money. Of course, it's not everybody else. It's the people at the top of the food chain, the wealth creators of this world who are getting richer. So it's not actually pushing up the prices of most day-to-day items, but for things which are in short supply, and that includes labor, housing, gold, equities, silver, Bitcoin, land, relics, works of art, those sorts of things which are in limited supply and are desired are likely to rise in price quite fast. Things which are made by robots, for the people at large, they're mostly mass-produced. They're made by robots, so the labor element which goes into that is relatively small. So there will be inflation in those things, but it won't be as high as the inflation in the kind of rare and more desirable goods.
Now, you mentioned how the interest rate on the debt is going to be increasing, and you, in a recent post you made, you wrote, to go over the numbers here, it's going to be $7.6 trillion of government debt has to be rolled over, mature. It's going to mature in the next 12 months and, financed at higher interest rates. So it's interesting how we've had interest rates for high for quite some time now, but the full effects of that have not been realized.
Well, the funny thing is we've seen two cuts in interest rates, the short-term rate, the Fed funds rate. They've cut rates by 0.75%. But since the day they made their first cut, the yield on 10-year government bonds has risen by 0.75%. So at the one end, we've had a cut at 0.75 at the short end, and at the longer end, the 10-year end, which is not totally the long end, but it's sort of middle of the range end, we've had a rise of 0.75. So what's happening, I think the bond vigilantes are out there, and they're saying, you know what, cutting rates isn't going to stop inflation. It's only going to encourage inflation down the line. And I want a higher yield to compensate me for the probability that interest rates will be raised next year or the year after. So I'm not such a bull. I think whilst I think interest rates are going lower in the short run, I think that's a temporary phenomenon. And I think we'll probably by the middle of next year, I'll be talking about rate rises.
Now, one of the main ways to prepare for this inflation is obviously investing in precious metals. I did want to ask you about recent price movements in the precious metal markets. We've seen a pullback here, a little bit of recovery, but your take on this short-term price movement, and then what is your long-term projections for both gold and silver?
It's had quite a rally this year, but people are still very disillusioned with what it's done over the last decade. We mustn't forget that we had roughly 10 years from about 2010 or 11 when gold did nothing and the stock market went up maybe 3 times. That was in complete contrast to the decade before that when gold went up 3 times, something like 300%, when the stock market went negative. So the S&P 500 went down over a decade and gold went up a lot. That was from 2000-ish until from when the stock market crashed in 2000, the dot-com bubble burst, through to about 2010 or 11. And then we had a period where the stock market was the star performer, and still is, by the way. So people have looked at the gold price that they had, and many of them bought it at the end of the bull market in 2010. And they're saying, I've had it for a decade, it's done nothing. And it's just a little bit above my purchase price, but look what I would have made in stocks. So they're selling out of it. I think there's a huge amount of nervousness about the gold price. That will dissipate over time. And eventually when the bubble, I'm going to say it's a bubble, but let's say the huge rise we're seeing in the top 10 stocks in America, when it comes to a halt, as it surely must do at some point, and I'm not a bear here, I'm just saying it's got a little bit ahead of itself. But when that stops and pauses for a reasonable length of time, people are going to be looking around for other things which are rising. And of course, gold could be one of those things that they move into. As to my price projection, we're about $2,500 now. It would be quite a thrust to get to 3,000, which was, for many, the year-end projection. I think it's still possible. We've got a few weeks to go, and it could move very, very fast on very little news. But I think we will probably move a little bit higher before the end of the year. But when we go into the new year, people and investment managers are going to be looking for the story of the year. And as they go into the 31st of December, they're going to want to be holding those hot assets, the NVIDIAs of this world, the things which have gone through the roof, because that's what their clients will be saying. Do you hold any NVIDIA? Do you hold any Bitcoin? Those sort of questions, because they're hot assets. I don't think they'll be getting that many questions about gold. But once they pass the 31st of December, it'll be time for a little bit of portfolio rejigging. And I think that a lot of investment managers will increase their exposure to gold, bearing in mind that stocks have done so much better and it's maybe time for a catch-up in gold. Where do I think it's going to go? I think we'll probably go somewhat higher in 2025. My target for 2026 is, I think we'll be well within the range of 3,000 to 7,000. I'm going to say high 5,000s probably. And that would merely be playing catch-up with the level of government debt. The amount the government debt has been increasing since 1971. So just playing catch-up would take us into the high 5,000s. But of course, it would have to go an awful lot higher if they wanted to have any form of backing of the currency with gold. There's no suggestion that they're thinking of that at the moment. But if we get into a currency crisis and there's a generalized level of distrust for some reason, and that's not looking likely yet, but it could happen for some unforeseen reason, then they might have to back the currency by something. And if they were to back it, there's no way they're backing it at $5,000 an ounce. It's going to be $100,000 an ounce or $70,000 an ounce or $150,000 an ounce. It would take that sort of level of gold price to cover the amount of national debt that they've got.
Now, when it comes to the price of gold, you mentioned how maybe $5,000 would be more fair value compared to how much debt. Can you maybe run us through the numbers? How do you get to that $5,000 level right now?
So what I did, I took the level of debt in 1971 and the gold price in 1971, which was effectively $35 going on $40. And I haven't got the figures in front of me, but I projected that forward to the present level of debt, which is 30 trillion. And if the gold price has kept pace with it, the gold price should be in the 5,000 and the high 5,000s already. Simple as that.
Well, that's very encouraging for those holding precious metals right now to kind of look at the math in that respect and say, it definitely seems, even though we've seen quite a bit of run, that on these fundamental aspects, it's still very, based on these fundamental aspects, it's still very undervalued. Now, when it comes to other assets to invest in, you talk a lot about the stock market. We're seeing, as we record this on Tuesday, December 3rd, that we're seeing pretty much all the indices here in the US at all-time highs. Your perspective on where the stock market is and where it might be going in the next new year?
I always like to think of it as a market of stocks rather than stock market. Because today, the stock market in the United States has become effectively 5 or 10 stocks. That's it. Because those stocks represent huge percentage of the S&P 500. So whatever those 5 or 10 stocks do, the S&P 500 index is going to do the same thing. But it doesn't just, and of course, if those big stocks go down, everything will go down with it because everything's very correlated. But it doesn't mean to say that a lot of the stocks in that index are overpriced. Yes, I think the larger stocks, which are quite reasonably high, unusually high price-earnings ratios, I think they're a little bit overvalued. If I take NVIDIA as an example, it's priced at 57 times next year's revenue, not profit, revenue. Out of that revenue, they have to take the cost of the employees, the cost of the material, taxes, and all kinds of things. Now, I wouldn't buy, if I wanted to buy a sandwich shop or a restaurant, I wouldn't buy it for 57 times its gross takings, because after I've had my costs taken out, I'll be very lucky to have half that. I wouldn't be buying it at 30 times its profit. I mean, I'd probably want to buy a restaurant, even if it's got lots of growth potential, at 5, 6, 10 times earnings. It's got a lot of growth potential. I might go to a bit more than that, where if it's 20 times, I'd be earning 5%, which is roughly equivalent to what I might be able to get on a money market fund or a bank deposit. But I wouldn't be going beyond that. So these technology stocks are trading at very high multiples, where the amount they're earning for their shareholders is way less than what their shareholders would be getting on a time deposit. But on the other hand, they've got the capital growth. When I say capital growth, the share price growth, because that's what's happening. The shares are rising and rising. And of course, these companies are doing very well internally. They're producing huge increases in profit, sometimes as much as 100% increases in profit, 100% increases in sales. But there's still an awful long way to go before we get to any sort of reasonable price-earnings ratio. So even if you look at 5 or 6 years' time, they might only by then be making a normalized level of profit where you say, I'm getting enough. But by then, a lot of the growth might have gone out of them, and one or two of them, I'm betting, will have fallen by the wayside anyway. So so let's say one or two have fallen by the wayside. So you lost out of the top 10, you've lost 20% of your value out of that, and the others have all seen huge growth in their earnings and sales, but their multiples are now trading at more normal multiples, and therefore you haven't actually made any money on them at all. You just trod water for a decade. So what I think about the stock market is, I think if you're investing in the stock market, it makes sense to diversify into a wider range of companies, the mid caps and the small caps, and especially foreign companies, where the multiples are much, much lower. Yes, the growth isn't the same with these smaller companies as it is with the very large caps. But what we're talking about is the huge valuation gap which has opened up. And why is this valuation gap opened up? It's all to do with the ETFs and index and mutual fund investing. People are perhaps looking at some of these high-valued stocks and saying, I can't buy it now. Look how much it's gone up. I should have bought it 3 years ago. So they go to their bank manager and say, what shall I invest in? I don't want to buy these overpriced stocks. And the bank manager says, well, I've got this really good fund. It's done X% a year for the last 10 years. Look how wonderful it is. Oh, that sounds like good. I'll buy that one because they've got good managers. Except that top-performing fund inevitably has those very same stocks that people are reluctant to buy. And the same thing applies if you go into an ETF, you buy an S&P 500 ETF, you've got a huge percentage of what you've invested in those top overpriced stocks. And money continues to flow into the stock market because historically, and it probably will be true in the long run, historically the stock market has been a very good place to park money. You've got real businesses who are working for you. The directors are doing their damnedest to increase the earnings. They're doing their damnedest to increase the sales. And if they don't do their best, they're likely to get fired or thrown out by the pension funds who will vote them out. So everybody, when you invest in the stock market, everybody is working for you. So not only are you conserving your capital value, but you're receiving dividends. But the trouble is, what do you pay for what you buy? If you pay too much, you might have a long wait before the multiple, because the rising earnings, the multiple contracts to a more reasonable level. If you buy something lower down the scale, the mid caps, the small caps, where the multiples are much, much lower, you won't have to wait so long. Even if there's a dip in the market, you won't have to wait so long for it to come back to some sort of normality. So I'm a bull of the stock market, but or I'm a bull of stocks. As for the stock market, I do fear that we're going to, at some point, see either a dip or a pause. And I think that for that reason, I'd try to stay diversified and not be over-invested in those very exciting from a business point of view, high-tech stocks.
Well, Clive Thompson, we really appreciate your time as always. If our viewers are interested in learning more about any of these topics, you write very often about these on LinkedIn. Can you share a bit about that?
I don't operate on Twitter or Facebook or any of the other social media platforms. So I'm quite happy to once or twice or 3 times a week write an article about something. Might be about the Federal Reserve's balance sheet. They are deeply in debt. It might be about the level of government borrowing. It might be about the inflation rate. It might be about the labor statistics, which are have been horribly fudged over the last few years. Those who've got questions are welcome to write to me with their questions, their financial questions. I'll be happy to answer them. I don't give financial advice, but I give my opinion as to whether your direction of travel sounds like it's wise.
And as we look into the end of the year, any last thoughts for people paying attention to the markets these days?
Well, 2 things. End of every year, we get what's called window dressing. Window dressing is what portfolio managers do towards the end of the year. They sell things which look bad, losers, and if they either they keep or they buy more or they buy some of those best performers, because they know as they reach the end of the year, come January or February, they're going to be presenting to the board of directors, the board of trustees, to the pension fund committee, whoever it happens to be, the charity committee. They'll be presenting the portfolio. And you want to go to a meeting with as few losers as possible in that portfolio, so you've got to weed them out, and as many stocks that people think you ought to have owned. Now, it doesn't matter that you bought them the week before. I mean, you fudge that. You say, we got a really good portfolio. We got Microsoft, we got Nvidia, we got Apple, we got Netflix and Tesla and all these stuff. And you can go through it. Nobody's going to, unless they're really smart and switched on, is going to say, did you buy that one last week by any chance? They don't know. They're just going to see it there and say, looks like a good portfolio. It's got all the winners in it. So I think as we go into the year end, that window dressing will push up the winners of this year. It'll push down the losers of this year. But come the new year, it's time for portfolio managers to rearrange the portfolio. And there would be, therefore, I suspect, some sell-off in the best performers as they move into something which they think will be hot next year. And I think that thing that they'll move into will most likely be the commodity stocks, the mining stocks, gold and silver. The other thing to mention is the debt ceiling. On the 3rd of January, 2025, whatever the level of government debt is becomes the new debt ceiling until they vote to raise it. What that means is the US government will not be permitted, the Treasury will not be permitted, to borrow any new funds. They will not be able to increase the level of debt. Now, they'll survive for a while because they built up a cash war chest, which will allow them to survive for a number of months. And beyond that, if the government hasn't agreed a higher debt ceiling, they'll start raiding the government pension plans, as they've done in the past. But I suspect the same thing will happen as has always happened in the past. They'll raise the debt ceiling and they'll be back on their borrowing spree. But what if they don't? Well, that's where the situation where they start to say, government employees have got to come to work, but we're not going to pay you, or we're going to delay your pay, or maybe you don't come to work, we shut down some departments. So we'll see if we get to that situation. But when we have wranglings about debt ceilings, it does cause people to question the creditworthiness of the United States, because it's never happened, and it probably won't happen. But the worst thing that could happen is they get to a situation where somehow they can't pay the interest on the national debt because they haven't got the money and they're allowed to borrow it. So it's always a period to watch out for.
It definitely is a period to watch out for, and whether that happens, them just saying that they don't have the money to pay the debt, or if it ends up coming from the printing press, right, that causing inflation. We'll see how that turns out. But Clive, we really appreciate your time as always. Again, if our viewers are interested in learning more, there will be a link to your LinkedIn in the description of this video. Thank you so much for your time. I hope you have a Merry Christmas if we don't speak to you before then, and God bless.
Yes, have a Merry Christmas to you, Elijah, and thumbs up for all your listeners and viewers.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for December 3rd through December 10th, 2024, while supplies last. Right now we have 1 ounce silver backdated South African Krugerrand at just $3.19 over spot per ounce. We also feature the limited edition 2024 1 ounce gold UK Lion and Eagle coin at just $99 over spot per ounce. And finally, 1/10 ounce gold Britannia are just $29.99 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.